Welcome to Money on Tap. Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this show. We look at all sides of the issues, and we bring a fully independent planning perspective to the table.
Welcome back. You are listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. All right. Let's take care of a couple pieces of business here right out of the gate. First of all, welcome to Money on Tap. If you're new, we're glad you're here. What are we doing? We're three financial planners from Brayshaw Financial Group. We put together a podcast for you on a weekly basis where we bring independent planning, all different perspectives, and basically put you in the center of the room because you're the most important person that's here today. You're here for you to make sure that you're getting what you need to be successful in your investing and wherever you're at in your financial journey. We love the opportunity to connect with you. What can you do for us? Want to thank you for going out and subscribing in the podcast world. Leave us a star, 5 stars, whatever that is, but just let us know that you're out there and you subscribed. And even better, if you leave us a review, we really appreciate that. It helps us out in the podcast world to get, higher subscriptions and listens and likes and all that stuff. And because you're so generous to us, we want to make sure that we're giving right back to you. Send us an email at info@yourmoneyontap.com, and we will send you over some Money on Tap gear. And I don't mean just a simple little tchotchke. I don't mean just a pen. And by the way, people come from miles around just to get a pen from us because they are that good. They're the kind somebody takes it off your desk, and you chase them down and you find that pen. Trust me, we've been there. We've done this. But it's good stuff. It's good gear, and we want to make sure that you know how much we appreciate you here at Brayshaw Financial Group and Money on Tap. Because we love you so much. We love you so much. We have put together a show today for you. And, last week we were show number 300. We've been doing Money on Tap since 2016. We started out with the first episode, Death and Taxes. And I was pretty excited about that show, but believe it or not, I am just as excited about 301, because it's that good. And I just can't wait to get this information to you so you can be successful in your investing. With that, yes, I'm Seth Crustman. With me today, Ben Brayshaw, Dan Mickelin. How are you guys doing?
I'm doing good, Seth. This show today is probably holds a lot more weight than people understand, and it's going to give them a lot more ability to really, target in and line up the sights on, their retirement years. This is going to be some really valuable information on, portfolio development, looking at your 401k in a different light, strategizing, structuring, maybe even giving you a solution if you feel like, hey, the allocations I chose 10, 15, 20, 30 years ago are still the same ones, and I haven't even looked at it because I have no idea what choice I should make. I didn't make the choice to begin with. I met with some guy. He told me to choose these and set it and forget it. I hate those words, set it and forget it. It's the excuse that people hold on to because they don't have the empowerment to really make changes and decisions about moving their portfolio, in the right direction. Well, today we're going to give you answers on how to take the reins on that in a way that, even if applied in the smallest way, will still give you a better opportunity to see stronger performance. And I'm excited about that.
Yeah, I think this is a great show for kind of both ends of the spectrum, right? For the do-it-yourselfer, I think we're going to give you the basic principles and some of the terminology you need to do a little bit of research and get yourself on the right track, right? We're going to give you the path to run on that you can then take right into the website and manage your own 401k and get yourself in a position to do better than the whole either set it and forget it or just kind of click around and make some guesses. We're going to give you the path to run on. But for people who rely on professional advice, we certainly welcome these conversations. You're going to leave this show prepared to ask better questions and to have a better understanding every time you sit down with us as to what's going on, or any professional for that matter, what's going on behind the scenes. How do people structure things? And it'll lead you towards asking, why this piece of that allocation for this time. And I think those are wonderful conversations to have with people. That's really exciting from our side of the table to get engaged like that with people.
Almost as important as the content of this show for you today is the title, which we usually spend about an hour arguing about before we start recording our show. For you today, The Art of Allocation, Mastering Portfolio Design. Ooh, yes. With that, it is time for Money in the News.
His first article from Reuters, Tesla again seeks shareholder nod for Musk's 2018 pay voided by judge. And this is a story we've been following quite a bit, and we've got a little bit different take on it than perhaps most. Elon Musk has led Tesla to great success over the years and enriched many people by doing so. It's a bit of a struggle for him lately, that the stock is certainly taking a little bit of a dip, but he's run into tremendous issues with his board over his compensation package, which my opinion on it, and I think we'll probably get everyone's take on this, when it was laid out, he was willing to take the gamble. He said that he had zero compensation, was going to be rewarded through stock options based upon the value of the stock, the price of the stock, which in turn is obviously the value of the company, and everybody who was in holding stock benefited from, his experience and his kind of rapid rise with that company through the burgeoning EV market space. But he's had some issues with a particular judge on a couple of issues, and some of that compensation structure has been struck down. And, personally, I feel like he's perhaps getting a little disengaged with Tesla, and I wonder if some of these compensation struggles have anything to do with that. But his record-setting compensation was to be $56 billion in pay, and that was set back in 2018, which is an absolutely staggering number, of course. But he built the company up to over $650 billion in value in 10 years, which is, again, incredible growth. And for a guy who's willing to kind of take that gamble and receive no compensation along the way, my personal take is he earned that. I mean, that was the contract that they all entered into before that success was realized. And here we are. And they're looking to claw it back from him.
I just can't believe that. I mean, this isn't even a shareholder dispute. Like, it was voted on, agreed to. Like, this is just a judge saying you've got too much money. That's not their decision. I mean, it just doesn't even make any sense. This is just he has to hit the numbers to make it happen. I mean, it's crazy. It's absolutely crazy that this is even a problem. I mean, do I need $56 billion in income? No. Does Musk need $56 billion in income? Who am I to say? I mean, I'm sure he's got jets. I'm sure he's got this. I'm sure he's got that. I mean, just the security alone, I'm sure people hate Elon Musk out there. I mean, like the cost of living, you can't put yourself, a judge be like, well, this is how much I make, so therefore you don't need that much. Like, it's not their prerogative to decide what's fair. That's communism. I mean, even the concept of that is communism. Like, it was voted on, agreed to, accepted. People invested in the company. They buy the stock. That's their choice to invest with him. If he didn't even make the company public and created it to $500 billion, it wouldn't matter. The judge would have, no conversation here. I mean, if there was a huge uproar across the board among the shareholders, I would say, well, I'm probably not qualified to make the decision, but that's not what's going on here. And I think that's the part I think the judge is just being ridiculous and overstepping their authority. So.
Yeah, I think this to me has a little bit. I'm trying to think of what realm or picture could we put this into that we could relate. And what if, Tom Brady, right, the great one, were to say, "I'm going to go ahead and postpone some of my pay here for you. until I start getting you those rings, right? And Kraft was like, yeah, no, I'm willing to pay you way above and beyond what any other quarterback's ever been paid out there if you go ahead and get me 2 more rings, or whatever the deal is out there, the target was out there. And then you were to have, oh shoot, I'm going to forget his name. the
Goodell, Roger Goodell.
Roger Goodell, good old Roger Goodell, were to come in after the deal, right? And he got the rings and he got the whole kit and caboodle, and said, you know what, that's it. We've just never seen that pay structure. We've never seen that done. It's way too much, and we feel like you were friends with Robert Kraft, so it was because of your friendship with Robert Kraft that you got that deal.
And by the way, nobody's won that many rings before. So it's never been done before. Like Tesla's never done. No one built an electric car company before.
I'm sorry, you make too much money. I don't like that, so I'm going to change the deal.
I mean, July 2010, the stock was worth $1.33, $1.33. It's now worth $156.71, and that's at half of what it was at one point. And the stock continues to go down as they fight this stuff. This isn't helping the company.
Yeah. That price is post split, right? I mean, the stock split, so I mean, this is all post splits, everything. So you got more. It's just, but the actual share price, you put $1.33 in, and you're worth $156 today. That's 14 years later. So you bring up a good point there, Seth. If there's anybody's compensation that should get ripped right out of their pocket and burned in front of them, it's Roger Goodell's. So I'll put my vote in for that one.
Oh. Okay. All right. Good. I thought you were going to say Tom Brady, and I was like,
Dan has some
stop right there.
lack of love for Roger Goodell. We are now opening up a sports podcast, and we're going to.
I wasn't expecting to hit that chord today, but you got me going here, Seth. I'm ready to rip this table out.
Little tender still.
Yeah, those first 4 games they took away from Brady would have put a couple more number ones in his pocket. I'm still irritated by that guy, but.
I'd love Musk to give Roger Goodell a little science lesson. We could start there, and then we'll work out the compensation afterwards.
Hey-o, U.S. National Debt Tracker for April 16th, 2024. Hold on to your seat. See what American taxpayers you owe in real time. Thank you, Megan Henney from Fox Business. So, guess what? Yes, that national debt is climbing at an astronomical pace, has no signs of slowing, despite the heightened scrutiny over government spending. The national debt, which measures what the U.S. owes its creditors, increased to $34,600,000. Oh my gosh! The commas, and then there's a decimal point. Okay. So Monday afternoon, this last week, according to the latest numbers published by the Treasury Department, that's up about $50 billion from the previous day. So it's just such an unbelievable number that we're looking at by comparison. Just 40 years ago, $907 billion, which I remember those conversations, believe it or not, 40 years ago. I do, which people just were having a hard time wrapping their arms around that. Well, here we are kicking this one down the road a little bit more, and other people in the White House saying, "Look, we've been doing a good job. We've reduced that." However, that really seems to be in a comparison to the congressional budget, basically taking out the the COVID sequence of funding that they were doing. So took that away, and anyways, it's fun to see. To me, it's fun to see how people kind of fish around with this budget and try to make it, sound less than it is, or we're doing a better job than the last. Everybody's done, honestly, a horrible job in this, and there's just no end in sight. And that's the part that just makes my stomach kind of hurt a little bit. My heart, maybe even more for us, but that's what I got on that.
Well, the thing that's really scary on this national debt issue. It's like, hey, it's 34 trillion. That's horrible. But with unfunded liabilities like future payment of Social Security and Medicare and all this other stuff, this is just the guess of the unfunded liabilities that we owe today that haven't been paid yet. It's 128 trillion. But the 34 trillion in a decade is going to be another 54 trillion. I mean, it's like the numbers just don't keep going down. I mean, they just keep going up. And I'm kind of the mindset that, and I've listened to these people online, and I just think they're on drugs, or they're just, I mean, they call themselves economists. They have accounting degrees. I mean, like this is not a complicated thing. They try to make it so complicated to justify their spending and all of these programs. But I listened to one guy say, well, you know what? We just actually have to create more debt to pay the debt interest. And then therefore we could theoretically go on for hundreds of years like this until, I mean, that's like me saying, I've got a credit card. I'm just going to go get another credit card, borrow the money on that, and I'm going to pay that credit. I'm going to pay the interest payments on the other credit cards. And then when this credit card gets bigger, I'm going to get another credit card, and I'm going to pay the interest on the credit card I just got. And
hold on a second. I think I want to hop in my hot tub time machine to fix this. Is what that feels like.
Yeah,
Ben, you should run for Congress with a plan like that, Ben. You should get behind that podium and start pounding that thing. You got the plan.
This is what they're saying, Dan. I listened to this on CNBC. I was just absolutely appalled that they were suggesting this is an option. I mean, I remember talking about it on the show one time, and I was like, I get that works, but that doesn't change the fact it's still debt. And people are like, well, we have debts from other countries that are owed to us. Well, has anyone ever counted the amount of debt we've forgiven globally? It just makes me sick. We forgive debt globally, but then we pay the debt we owe that country. Like, why wouldn't that just wash out part of our debt? It's absolute craziness.
That's the thing with these numbers.
There's only two ways of dealing with the debt, right? Like if you have a credit card problem, and you're listening to this show, right? You're thinking, I'm either going to spend less, I'm canceling Netflix, I'm canceling, PureFlix, I'm canceling whatever you're canceling, right? You're canceling all of it. You're cutting your cable. You're not going out to eat. You're reducing your spending, or you're like, you know what? I need to get a second job. It's summer. I'm going to go mow some lawns in the evening. I'm going to do this. I'm going to go, I have a friend who's going to put a patio in. He's going to pay me some money. Like, you go find another job. Now, there's only two ways our government deals with it too. They either have to create more income like you would, or they have to spend less. Now, I don't see spending less happening anywhere, especially with the new Biden program of $7.5 trillion in new taxes and $5.5 trillion in new spending, which is totally nuts. But the only way our government brings in more income is through taxing us more. And that's what that $7.5 trillion tax thing is. This whole debt thing just disgusts me, honestly. We should be better than this in America.
Well, speaking of what Americans like to do, we like to throw away up to 68 million in coins a year. And here's where it all ends up. The Wall Street Journal and Doyen. That's as good as it's going to get. This is pretty darn close, though, on that name.
That's the author, folks.
That is. That's him. What is he lost his mind? Pretty close. So apparently a waste management facility in Mooresville, Pennsylvania, workers load incarcerated trash into an industrial machinery that separates and sorts metal and sends them to get hosed down. And then guess what? They get these buckets of quarters and dimes and nickels. Apparently, we are throwing away a lot of money because, frankly, it's just kind of a nuisance is part of what is happened in our world today. But, I'd be collecting some of this if I was going to get these $10 million worth of coins that they'd found.
In 7 years, it's, you said incarcerated, but incinerated trash.
Well, it's incarcerated, incinerated.
But they found, this is just one facility, $10 million worth of coins. And what's interesting about this article, I think it was only like 7 million of it was actually able to be processed back into currency that they were able to get money on. They know it's a quarter, but they can't tell it's a quarter. It's like, on some of that stuff. But what's really interesting is how much people throw away change because, buses, trains, they don't take coins anymore. So it's a huge problem across the board. And, people are trying to figure it out, but people are throwing change in the trash because they're like, what do I do with this? I just throw it away. It's 5 pennies. Well, it adds up. And this is just one facility, 10 million in 7 years.
It's incredible. But, there was a reference in the articles to if you lost a penny, you wouldn't really look for it. And it's just so true. And the relatable thing when I went through reading this article to me was, when I was a kid, I had the big coffee can and the tin can, right? So you go around collecting coins. Me and my sister would be rifling through the couch looking for loose change, throw it in the bucket. So it built up this, massive collection. But now when I'm walking around the streets with my kids and I see one of them bend down to pick up a penny, I'm like, oh, that's dirty. Don't touch that. Leave it. Whereas in my day, I was like, hey, great find. There'll be a couple more around here.
In your mouth, it would go in her head. It's like, oh, clean that right up.
Well, there's all this other stuff too. Like I was walking the other day with my kids and there was like a dollar bill blowing in the wind. I just went and grabbed it. And my kids were like, Dad, don't touch it. And I was like, why? They're like, people leave dollar bills and 20s and 100s with fentanyl on them. It's like some sadistic, evil thing that people have been caught doing. So I hadn't heard of it, but my kids were like, don't touch it. So I already had stuck it in my pocket.
Yeah. What?
Licked it.
You lived to tell about it.
I did not lick it and I lived to tell about it. So.
Yeah, boy. Oh, here we go. That's going to do it for us in Money in the News. We have the Art of Allocation, Mastering Portfolio Design show for you today. While we're taking a quick break here, go ahead, hit subscribe, leave a star, leave 5, send us an email, and we will send you some Money on Tap gear. Thanks for being here with us today. Don't go anywhere. We'll be right back with more Money on Tap.
Are you ready to take control of your financial future? Look no further than Brayshaw Financial Group. Our team of experienced advisors is dedicated to helping beginners like you build wealth through smart investing strategies. Visit BrayshawFinancial.com today to start your journey toward financial independence. Brayshaw Financial Group, your partner in wealth creation.
You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more Money on Tap with Ben, Seth, and Dan.
Welcome back. You are listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We are talking about the art of allocation, mastering portfolio design. And yes, thank you so much for subscribing to the podcast. And as a reminder, I know I've said it before, but we really want to make sure we get you some Money on Tap gear. And love the opportunity just to connect. With that, let's go. We want to go ahead and build our portfolio, right? And we're going to kind of try to break this down into about 3 parts for you. Each one of these, we hope, has some actionable steps for you to engage with creating or enhancing, either way, understanding more about designing the portfolio.
Yeah, Seth, and that first step, kind of the first of the 3 points we're going to get into today about how do you best go about this is, number one, understand your portfolio construction, right? You can really break down what it is that you have in your portfolio, tailor it around what your goals are, right? So the first thing you want to do as you go through the process of planning and constructing a portfolio is lay out what your goals are. Understand what the time horizon is relative to each of those. You can have a different portfolio suited for a different need to satisfy a different goal. For instance, if you're trying to fund for college, you might have a portfolio for that. Your retirement planning inside of your 401ks and IRA space, that has its own set of goals. And then in general investment account for maybe much shorter term things like vacations, saving for a car, down payment for a home. Each of these separate portfolios might have a separate goal and therefore might warrant different construction.
I think the goal piece, Dan, is something that's kind of missed in a lot of conversations. People just, they'll call us and they'll say, "Hey, I just need you to invest the money. Let's get this thing moving forward. Like, let's get it in the market, And when you don't have really a trajectory of what you're trying to accomplish, and the lack of accomplishment focus really drives kind of poor portfolio construction. I would tell you that, people don't understand time horizon, which is the goal, right? Like, I need this money in 2 years. I need this money in 10 years. I need this money in 30 years. Those kind of conversations dictate structure, time horizon, the risk ability you can take, what is your objective? All of these pieces come together, and there are actually definable compliance, conversations that exist in the background of every investment you ever make. Like, people are judging whether or not, your financial professional has done the appropriate due diligence that assesses your risk, your time horizon, and your investment objective. Those are 3 common conversations in every investment out there, and things that we're supposed to document in detail, as best we possibly can. Okay. And so when you start dealing with your portfolio construction, a healthy conversation is going to be, okay, yeah, I'm using this money for college. I'm using this money for retirement. No, we're saving for a condo in Florida when we retire in 5 or 10 years. These kind of goals really help us assess, a few different things, but where to put the money, how accessible, its taxable nature and scenario around that, as we detail just like the basic framework. When people don't have that framework piece to really start then diving into, well, this is going to be saving for, some second home in retirement. Well, this is going to be a taxable account. So we want to start evaluating the taxability and assessing what kind of holdings you're going to have to reduce the tax implications on your daily life while you're still working. Or, hey, this is an IRA account. Well, we can trade this thing every day and it's not going to affect your taxable scenario. So therefore, let's start making this money move. And, we might move it on a monthly basis. We talk to people about low risk investment scenarios that are actually retirement funds. We'll move those on a regular basis between money markets, which, have no advisor compensation, and just trying to get them an extra 1/4 or 0.5% based on what their scenario is, but we can move it all the time because there's no taxability to it. So there's a lot of conversations around portfolio construction and, how to get there that I think are kind of the big conversations first, guys. I mean, I think that's the piece that gets you down to the nitty gritty of what to invest in.
So one of the things I find are some common mistakes with this are we have everything in our savings, right? And that's all in CDs. And that's our portfolio design. Oh, okay. So that's the bucket for tomorrow in 5 years. And also, 10, 20 years down the road. And the other side of this is the person that's gone ahead and taken this project, which we want you to do, and breaking it all down into very granular pieces. And each one of these is its own little portfolio design and its own account. Who has the secret account out there that, okay, don't tell your spouse, right? That's not what I'm talking about, secret account. I'm talking about the one that you even try to get rid of and you're like, I don't know, it's there. It's out. I put the money over there, it disappears, and it's going to be there whenever I remember for whatever it's for. So these are kind of the fun little, games that we play with ourselves. We understand it. We get it. So let's go ahead and bring all those into the conversation, put them on the table. And if we can start to attach some of these values with it, a lot of these are going to be domiciled in the same bucket or in the same portfolio. They just have some, Swiss Army knife abilities to them. But to the point that Ben was making right here, really critical. Oh, I like to pop in that, pretend I'm the person that's got this scenario happening. But let's just say you're like, got the IRA. You've got $1 million in your IRA. Well, that IRA right there is for my retirement. Okay. Yep. I know 59.5 is when I have access to that without a penalty. Okay. Great. Earmark that. Part of the design. And at that time, I've got my dream house that I want to build over here. Oh, you do? Yes. Well, where's that money going to come from? Oh, your IRA. Wow. Did you know that $500,000 you're going to go over here and spend on that dream home? Well, guess what? That's now coming out of the IRA, going into your home as ordinary income, right? That's the taxability of it. And so that's what we're talking about. We're like, okay, let's just kind of work through and put a little bit a thought around this, and just to double check, and believe us, we've seen it happen, and the whoopsie-daisy is avoidable. And we're here to help make sure that's not part of your story, but it's very common. And don't be ashamed if this is part of where you're at. We're all in different stages with this. So with that, let's talk a little bit about diversification, our favorite portfolio word, right? With this, I think it's important for people to understand a couple of different things. What are we talking about in terms of diversification? Well, a lot of the times diversification gets, put into this conversation of, I have an S&P 500 fund, and I've got a Russell 1000 fund, and I've got a large cap, mid cap, blah, 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 blah fund, right? Fund. Stock. Bond. Okay, great. You've got these different things inside of the portfolio, and that can be very much a part of the conversation. And maybe that is part of diversification. But typically with diversification, what we're talking about or want to start to understand is a little bit around volatility and how much those have in terms of the volatility up and down, and if they're following and tracking with each other. Because if they're in step, if you've got fund A that's doing the same thing as fund B and the same thing as fund XYZ, right, in terms of the volatility when the market's moving up and down or all around, well, that's not diversification. And that's a real challenge.
Seth, that big word that people talk about, they talk about diversification. And it's like, well, let's diversify my investments. And there's this whole piece called modern portfolio theory. And it honestly, tasty. What's that?
Sounds tasty. Can I get that with a side of fries or?
Yeah. Well, so, they have all these big words and really it's just about balancing risk. And, as we get into the conversation about risk and as we kind of deal with, modern portfolio theory, I mean, you might as well just call it historical portfolio theory. And I think that's what's really missing is people don't understand that this modern portfolio theory and the design about building a diversified portfolio may or may not be suitable or relevant moving forward because it's really historical portfolio theory. And it's what it should be called because honestly, we're just looking backwards for the most part on, what have people invested in statistically, how have they mitigated risk, owning bonds and stocks and varieties of components and ways to own those bonds and stocks, whether it's bond funds, mutual funds, or ETFs or whatever. And, there's all these people out there chasing the greatest idea for what they should have done, how they should have done it to have made money through all these different historical market events. Right? I mean, everyone is back testing everything under the sun. Totally relevant, totally legitimate, all things that people should do. The problem is this. And we've talked about this on this show hundreds of times. I mean, I tell clients constantly that all the ways we made money historically are changing moving forward. And if people don't understand the relevant difference between what happened in our demographics as a country and where that demographic shift is occurring, people don't understand that modern portfolio theory may be, or these, historical methods of diversification may or may not be the best or worst thing you could ever do. Because it's, people are still buying traditional diversified portfolios. And at the end of the day, we had people who made money, these baby boomers who have made money over the last 40 some odd years, 50 years of how they made all of their assets and how they diversified and what they should have done to make even more money. But the thing is they're moving into retirement and they're not taking the same risk. Anyone who's walking or getting close to retirement is saying to themselves, we met with some clients today, we were talking with them and they're like, you know what? We're so close to retirement. We just don't need to take that risk. It doesn't even make any sense. It's not going to remarkably change how much income we get. But what could happen is if there is a remarkable downside turn in the stock market, that could change. That could meaningfully change our retirement and our income that we could get. And I think that's the piece that people aren't quantifying is that as the baby boomers continue to retire and they have all the money, they're selling all these high risk investments, which is forcing a lot of the strength in those investments to weaken. the foundation of those are weakening. But as they continue to buy more income-based, value-based, larger companies, more security, those assets are becoming stronger with significantly more interest. And that will continue for the next 20 years as the retirement population literally goes from 40 or 50 million to 120 million. We're going to almost triple our retired people. So I'll leave you with that.
Ben, you said it. It's risk time. As we head into a break right now, we've got an action step for you. That's for you to email us at info@yourmoneyontap.com so that you can receive your free risk assessment. We'll send you that, and we'll go ahead and help you understand what kind of risk are you? What kind of a risk taker are you? Is that in line with your current portfolio or the portfolio that you want to design, right, to be successful in investing? Don't go anywhere. We'll be right back. You're listening to Money on Tap.
Hello, everyone. This is Dan Mickle on Brayshaw Financial Group. Are you looking for professional guidance to kickstart your investing journey? Look no further. Brayshaw Financial Advisors are here to help. Our team of experts will provide you personalized advice tailored to your financial goals. Visit us at BrayshawFinancial.com today and schedule your free consultation. Brayshaw Financial, investing made easy.
Thank you for joining us for Money on Tap. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more of this week's show with Ben, Seth, and Dan.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Yes, we are. We are talking about portfolio design, the art of allocation, mastering your portfolio design. Good for you. You got that info out to, or that email out to us at info@yourmoneyontap.com. And now you have a risk assessment to go ahead and just start to answer some of those questions, get it back to us so that we can help you out with understanding. All right, what does this mean, this risk assessment, and how does this integrate with portfolio design? So talked a little bit about modern portfolio theory, which is kind of a fun, I mean, to me, it's funny that modern portfolio theory has been around for 50 some years. And at one point, yeah, that was very modern. And at this point, we just have more understanding. And that doesn't mean it's not, it's completely obsolete. There's elements to that we're going to want to take forward with us and incorporate as a part of this conversation. And this part of the conversation we're going to have is really about, theory behind designing the portfolio, different asset allocation strategies. Dan, could you take us in the right direction here?
Yeah, the modern portfolio theory, I think the benefit that holds true today isn't so much about, the metrics they use and some of that backward-looking test data that Ben was speaking to. And that just to take a quick moment on that, that's something that we introduce to all of our clients when we sit with them initially and take a look at the holdings that they have. Often in retirement accounts, that it's been a kind of set it and forget it approach where people just, kind of take a smattering of mutual funds and run with it. But the fact of the matter is that, tomorrow's investors are different than yesterday's investors, and the things that they choose to be invested in because of their risk tolerance and because of this massive shift of generational wealth that's becoming more and more conservative day by day, that's going to drive future performance. And some of those things are just not really captured in modern portfolio theory. They're just not. But I think the benefit of going through that kind of metric-based structural analysis that modern portfolio teaches us to do is to just get to the understanding that each investment you choose, each component of the portfolio is going to have both a different expected return and a different level of risk. So when you're choosing your investments, when you look at the metrics that are involved in that, and we'll get into a few of these as we kind of go through the conversation here, but understanding what each component means to you in terms of what it's expected to return or potentially could return, along with what the downside risk of that is to you, and then taking a look at all those different positions inside of the portfolio at once and coming to the conclusion of what your aggregate expected return is versus your aggregate risk that you're assuming, I think that's the fundamental part of bottom portfolio theory that we can carry forward. I think where it differs now is how we choose those individual investments. Which things we choose to allocate into aren't the same today as they were 25 years ago.
I think also there's, a lot of people deal with these, very large, investment firms, that are, whether it's their 401k, or just looking for low fee kind of scenarios, which I don't fault anybody for looking for that stuff. I think it's great. Like, what you're paying for something is totally relevant, whether you're buying a car or an investment or whatever. Now, I do think that, when you call some of these firms and you talk to this 20-some-odd-year-old kid who just, passed his securities license 6 months ago and is answering a phone and will probably never talk to you again, unless you're lucky to get him on the call center again, will help you make decisions based on this modern portfolio theory that we're talking about, that you hope will carry out the income that you need for the rest of your life. And I think that's one of the things that's not being addressed by kind of the big investment firms across the board, is trying to mitigate that, outside this modern portfolio theory, because unfortunately our industry will never get in trouble for giving you the same historical conversation that people have made money for years, irrelevant of what they know. Like, they're not going to get in trouble for putting you in a moderate portfolio because you risk ranked moderate. But if you risk rank moderate based on something that's historical, but theoretically could be a disastrous investment for you moving forward, that's not their fault. And unfortunately, that has some weight to bear, where, when you're dealing with a direct firm and people who have, vision and perspective, whether it's us or someone else, we have to answer to our clients. Like, we have to explain, hey, this is for, we've talked about it. The last number of years, we've taken less risk than the S&P 500 and beat it, in a combined scenario. But at the same time, this last year, we're up handsomely. But this individual year, this year to date, we haven't beat the S&P, but we've tracked and beaten our benchmark. And we explain that to people. And so not every year, not everything, people don't understand how everything moves. And you have to be able to talk to somebody who you can have a consistent conversation with and go through that and say, well, we're taking less risk. Over the last 3 years, we've beaten that benchmark. This year we're not, but in its combined performance, we are. And when people start seeing that and they start seeing the returns, like, they're happy. That's what they want. They want less risk, better returns. But that brings us to a whole other issue, which I don't want to jump into our part 3 too soon on you, Seth. But
one thing I wanted to point out real quick as we were talking about design, there's a difference between diversification and correlation, right? So when you're building one of these modern portfolio theory styled portfolios, if everything you have in there is, to kind of set the point to open the show, just a collection of mutual funds, it's strictly equities but you have every different index covered. When the market's up, the market's up. When the market's down, the market's going to be down. You need to have some component of that portfolio that behaves not related to the market. And that's what we talk about, something that's a non-correlated asset, right? There's definitely this rising tides effect in the whole equity space at any given time, in the same bond space with the bond space, but they don't move together. So you need that negative correlation, that non-correlated asset that's going to perform on its own, separate from what's happening in the S&P world.
Right. And I think from a standpoint of that, Dan, that's a fantastic point. From the standpoint of that, your longer term assets should correlate more with, the volatility of the stock market, pro or con. And your shorter term investments should correlate the least. And I think when you start talking about that and the overlap of portfolios, we start getting into a combined conversation, because when Seth was talking about, a kind of a smattering of mutual funds, at some point in time, when you overlap those assets, you want to make sure you're not, overly allocated to one specific fund. Like, you could choose 10 different mutual funds. 8 or 9 or all 10 will all have Apple in them. And at some point in time, you're like, well, what's my direct percentage of Apple ownership? Because Apple went from 180, 190 down to 165. Well, that's a pretty serious drop for a big blue chip growth asset. So, are you overly allocated indirectly? And talking about those overlaps has a conversation to do not just by diversifying your portfolio individually, like your IRA or your non-qualified, but looking at your overall holdings, no matter what you're doing, taking the whole portfolio and seeing what stocks do I own a significant percentage of? Am I overexposed in any one area?
So we've gone into a little bit around the modeling, right? What are we kind of looking for? What are the questions we're asking? What are some key things that we can start to work or take a look at as we've, first of all, understood our risk? Now we've also got the risk alongside our goals, and we've pulled these pieces together, and we have, whatever those parts and pieces are, and we started to create some timelines around some of these goals. Okay, so does anybody have a guess on short-term goals? What kind of risk do I want to be taking in that? Typically, it's going to have less volatility, less risk. Okay, so that doesn't mean that applies across all parts of our portfolio, because balancing the portfolio doesn't necessarily mean it's equally weighted in each one of these segments and sectors and it's perfectly balanced. Balance means it is balanced towards the parts of your goals and those needs and those timelines. That's part of balancing it. And then not only, what parts of the market are we participating in, okay, or what kind of segments of investments are we in, those real estate holdings, those, a typical balancing act inside of a whole portfolio strategy might be participating in hedge fund like strategies. And, those are different parts and pieces. So what we want to start to take a look at is inside of this balancing, right? Have you covered not only those asset classes, but have you covered different styles of investing, the strategic, the tactical, dynamic, all these kind of parts and pieces? So right now, action step for you. Go ahead. All right. We're going to have we're going to have your risk tolerance with you. Now start taking a look at different investment options inside each one of those investment classes. All right. Take some notes, write it down, start to try to understand a few of these parts and pieces. You're listening to Money on Tap. All right, we're going to take a quick break. And while you're writing those parts and pieces down, please, thank you for subscribing and letting us know at info@yourmoneyontap.com. We're going to take a quick break and we'll be right back with more The Art of Allocation, Mastering Portfolio Design. Hey, Seth Cressman with Brayshaw Financial Group. Are you looking for professional guidance to kickstart your investing journey? Look no further. Brayshaw Financial Advisors, we're here to help you. Our team of experts will provide professional, personalized advice tailored to your financial goals. Visit BrayshawFinancial.com today and schedule your free consultation. Looking forward to seeing you there.
We appreciate you listening to Money on Tap with Ben, Seth, and Dan. You can contact us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more of this week's program.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We are in the final stretch here of The Art of Allocation, Mastering Your Portfolio Design, and have covered quite a bit. We still have a little ways to go here, but we want to make sure we get through, that after we've created this portfolio, now that you've got it, kind of put together, ready to deploy, what are we going to do? How do we understand it? Jan?
Yeah, I think there's a couple of components to that, and really the conversation gets into things like metrics. Right. So there are numerical measures that you can use to take a perspective on how well you're doing. A couple simple things like that, a couple simple things relative to that are calculating your total return. Right. So you need to understand how you've performed. And that performance can be derived out of a couple different categories. It can be done through capital gains. How much has the stock appreciated? How much of that, or the portfolio rather, how much of that portfolio appreciation is driven by actual, increase in the price of each individual investment, and how much of that is produced by dividends and interest, as an example. And understanding, well, at some point, what does that mean to me? What level of distribution am I going to be able to take from this to satisfy that goal, whether that's a lump sum kind of in and out opportunity, or when we're talking more so about retirement assets, how long am I going to be able to stretch this money and provide myself an income? But that's just, one of the metrics. Another thing that's important, particularly when you're trying to really get to the level of self-evaluation on portfolio design, is understanding benchmarking. A lot of people come in, often just saying, hey, listen, I've underperformed the S&P 500, and that's a concern to me because I see that number in the newspaper all the time, or watching the news, wherever you get your kind of financial media exposure. People point to the market, they're referencing the S&P 500, and they wonder, why am I not in line? And then when we take a look at that portfolio, you realize it's a 60-40 mix of 60% equities, 40% bonds. I mean, the easy answer of why haven't I performed that way is because you don't own that. 40% of your asset allocation today is in bonds, which is significantly less risk, and you should expect significantly less performance with that portion of your portfolio.
Yeah, people don't take the averaging into account that, like, hey, listen, I've got 60% of my portfolio performing just like the market, and 40% is way underperforming it, and the average is underperforming. But that is a diversified portfolio, and that's how you reduce your risk, is to take assets and invest them in less risk. I think, when it comes to 401ks, which is probably, or retirement plans at work, which is probably the largest, or second largest asset for most people separate from their house, allocating that and understanding how to allocate that is something like, well, how do I do that? Hey, I've been listening to Money on Tap for, 8 years. And, how do I translate all of this information into my retirement plan, which, you guys can't manage directly? Well, you know what? We can help you manage it. There are ways that we can help you manage it. We actually have the ability to take, your available investment allocations in your 401k, plug them in our system, and try to give you an optimized opportunity on where to allocate based on your risk tolerance, time horizon, and investment objective. And we can give you some guidance on that, because most of our listeners, I'm sure, and you're not alone, don't have the first idea what they should really be investing in. Someone told them what to do, and they don't know what to move it to, or that they should move it. And they feel like if they make a decision, it's going to be the wrong one, and the one they did own is going to do well, or some scenario, because they don't have the educated approach. And you're not alone in that, and that's okay. But we have the ability and guidance, and some of it's very low cost ability. We can give you general oversight for a fee. We can give you very specific oversight on a fee. And these are things that are worth it to really make sure that your retirement plan has some general oversight. It's not expensive. It's something you can give us a call about. I think it's worth it, but understanding how to rebalance your portfolio and make sure you're making the changes when you need to, and addressing it even at least quarterly, is what everyone should be doing from a competent, educated perspective to drive the most opportunity for returns or protection of losses, or some mitigation of losses based on your risk tolerance.
Yeah, this just makes a lot of sense in different ways. Let's say, for instance, you're buying a house. You know the rate, your loan. Everybody does, right? It's not just conversation that you have one time. It's one that you are concerned about and you think about, and it's regular enough for you to think about the largest investment you have. How is that doing? How can I manage that a little better to get to my goals closer? Same thing. So many people inside just the 401k world either don't even rebalance. Simple. That is an easy thing to set up on a set it and forget it. We prefer to be engaged in that, because the more that we're engaging in our finances and the more that we're paying attention, probably the more that we have some of these goals and we're actually getting closer to them, or let's achieve some of these, right? So let's do that and not just pay attention on, what's already happened, but let's look forward and see what can we do to really use these tools to get ahead. Be successful in your investing. You guys, this is it, your show on the art of allocation, mastering portfolio design, with us here at Money on Tap from all of us here at Brayshaw Financial and Money on Tap, thank you for being here. Thank you for subscribing, and just thanks for being you.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through Osaic Wealth Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of Osaic Wealth Incorporated. Osaic Wealth Incorporated and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire 03110, and can be reached at toll-free 855-226-8551.
Well, bye.